Welcome to Educounting, where we're passionate about financial education. Today's video is on managing tax rates in early retirement. It's not always possible to greatly reduce your taxes. In the right situation, however, there can be some big opportunities. Planning is the key. Understanding when a situation presents itself and taking advantage of it is important. This can be critical in early retirement. Tax rates currently jump from 10% to 39.6%. A good way to think about taxes is having several buckets. When you fill up the 10% bracket, any overflow is then taxed at 15%. Not everything, only the overflow. And when the 15% bracket is filled, the overflow is taxed at 25%. Understanding the blended rate is important, as you may end up in the 25% marginal bucket. But since a portion is taxed at 10% and another portion at 15% and 25%, your average will be less. While working, taxes are generally higher because of your salary. After you retire, income can drop until Social Security and your required minimum distribution starts. Sometimes you may have a small pension too. There are 3 phases of retirement. The first is pre-retirement, where your salary is high and it puts you in a high tax bracket. Phase 2 allows you an opportunity to delay Social Security to increase your payout, and your RMD hasn't kicked in yet. Even with a small pension, you could be in a lower tax bracket. In Phase 3, you now have Social Security, your RMD is kicked in, and you have your pension. This pushes you into a higher tax bracket compared to Phase 2. In this strategy, there is no change in Phase 1 as your salary doesn't change. Since you'll be in a higher tax bracket in Phase 3, you can pull some income into Phase 2 at a lower rate by converting part of your traditional IRA into a Roth, carefully filling up your lower tax brackets. Now in Phase 3, you can manage your taxes and bring down your tax rate. Watch our longer video on this strategy outlining how this makes your assets last much longer. If you are charitably minded, think about offsetting a Roth conversion with a donor-advised fund as well. Make sure to check out our video on the topic. By being taxed at a lower rate now, you aren't pushed into the higher tax rate later, thereby saving money. You move money into your Roth IRA, which gives more flexibility and no tax on the growth. Your flexibility increases because you don't have RMDs for a Roth and you can manage your taxes in retirement. This makes your money last longer. Thanks for listening. Here's to making better decisions based on better data and better education.